Ever notice how some people seem to get paid just for owning things? Like that friend who casually mentions they made $200 last month without lifting a finger, or your neighbor who brags about their portfolio, sending them checks every quarter while they're sipping coffee on their porch. Meanwhile, you're wondering if these people discovered some secret money tree growing in their backyard that nobody told you about. Well, they didn't find a magic tree, but they did find something almost as good. They discovered the world of dividends, and honestly, once you understand how this works, you might start questioning why you're still trading your time for money when your money could be working for you instead. My name is Nick, and I help people understand how money actually works so they can stop feeling like they're always one step behind everyone else financially. If you're tired of watching other people collect passive income while you're still figuring out where your paycheck disappears to every month, make sure to subscribe to the channel and hit that like button if this video helps you see the bigger picture. Here's what's fascinating about dividends that most people completely miss. When you hear someone talking about dividend payments, your brain probably thinks it sounds too good to be true. Free money from companies just because you own their stock? Come on, that's got to be some kind of scam, right? But here's the thing that'll blow your mind. Not only are dividends completely legitimate, they're actually one of the oldest and most reliable ways that wealthy people have been building and maintaining their fortunes for centuries. Think about it this way. When you put money in a savings account, the bank pays you interest. When you lend money to the government by buying bonds, they pay you interest. So why wouldn't companies pay you something for letting them use your money to grow their business? And the only difference is that instead of calling it interest, they call it a dividend. And unlike that pathetic interest rate your bank gives you, dividends can actually make a meaningful difference in your financial life. But before you get too excited and start imagining yourself as some dividend mogul collecting checks while lounging by the pool, let me explain exactly how this whole system actually works. Because like everything else in the investing world, there's more to the story than just companies handing out free money to anyone who asks nicely. When a company makes a profit, they basically have two choices with that extra cash. They can either reinvest it back into the business to fuel more growth, or they can share some of those profits with the people who own the company. And who owns the company? The shareholders, people like you, assuming you've bought stock in that company. Now, this is where it gets interesting from a psychological standpoint. Companies don't just randomly decide to start paying dividends because they're feeling generous. They typically start paying dividends when they've reached a certain level of maturity in their business cycle. Think about it like this. A young, scrappy startup is going to take every dollar they earn and plow it right back into growing the business. Like they need that money to hire more people, develop new products, expand into new markets, and basically do whatever it takes to survive and thrive in a competitive world. But what happens when a company has been around for decades and has already conquered most of their addressable market? What do they do when they've got more cash coming in? Then they can reasonably invest in growth opportunities that make sense. That's when the board of directors sits around a conference table and says, you know what? Maybe we should start sharing some of this wealth with the people who believed in us enough to buy our stock. This is why you'll notice that a lot of dividend-paying stocks are what we call blue chip companies. Like these are the household names that have been around forever and probably aren't going anywhere anytime soon. Companies like Coca-Cola, Johnson & Johnson, Procter & Gamble, these aren't the exciting growth stocks that might double overnight, but they're the steady, reliable companies that have figured out how to print money year after year. And here's something most people don't realize about dividends. They're not just some arbitrary number that companies pull out of thin air. The amount and frequency of dividend payments tells you a lot about the company's financial health and management philosophy. A company that consistently pays and even increases its dividends year after year is essentially telling the world that they're confident about their future earnings and cash flow. Let me give you a simple example of how this actually works in practice. Let's say you decide to buy 100 shares of a company that trades for $50 per share. You've just invested $5,000. Now, This company announces that they're paying a quarterly dividend of $1 per share. Since you own 100 shares, you're going to receive $100 every 3 months. Over the course of a full year, that's $400 in dividend payments. Now, $400 might not sound like life-changing money, but think about it differently. That's a return of 8% on your initial investment, and you didn't have to sell a single share to get that money. Your original investment is still sitting there, hopefully growing in value over time, while simultaneously paying you to own it. It's like buying a rental property that not only appreciates in value, but also sends you rent checks every quarter. But here's where things get even more interesting, and this is something that separates people who understand wealth building from people who just think they do. Most dividend-paying companies offer something called dividend reinvestment programs. Instead of taking that quarterly payment as cash, you can automatically use it to buy more shares of the same company. This might seem like a small detail, but over time, it creates what we call compound growth on steroids. Those reinvested dividends buy you more shares, which means you'll receive larger dividend payments in the future, which means you can buy even more shares, which means even larger dividend payments. It's a beautiful cycle that turns small amounts of money into substantial wealth over decades. And speaking of decades, here's something that might surprise you about dividend investing. It's not a get-rich-quick strategy. In fact, it's pretty much the opposite. Dividend investing is for people who understand that building real wealth is a marathon, not a sprint. It's for people who can look at a quarterly payment of a few $100s and see it not as pocket change, but as the foundation of their future financial freedom. The companies that pay the most reliable dividends aren't usually the ones making headlines for their explosive growth. They're the boring companies that make products you use every day without thinking about it. The company that makes your toothpaste, your laundry detergent, your morning coffee, these companies might not be exciting, but they're profitable year after year, which means they can afford to keep sending you those dividend checks whether the economy is booming or struggling. Now, you might be wondering about the tax implications of all of this dividend income, and that's actually a smart question that most people don't think to ask until April rolls around and they're staring at their tax forms in confusion. The government actually treats dividend income differently depending on how long you've owned the stock and what type of company paid you. If you've held the stock for more than 60 days before what's called the ex-dividend date, and it's from a US company or certain qualified foreign companies, your dividends get taxed at the same rate as long-term capital gains. This is usually much lower than your regular income tax rate, which means Uncle Sam is actually encouraging you to be a long-term dividend investor. But if you're the impatient type who buys and sells stocks faster than people change their Netflix passwords, those dividends get taxed as ordinary income at your regular tax rate. The government's basically saying, hey, if you want the good tax treatment, you need to actually commit to owning these companies for more than a hot minute. Here's where dividend investing gets really interesting, and this is something that most financial advisors won't tell you because it doesn't involve selling you expensive investment products. You don't have to pick individual dividend stocks and hope you chose wisely. You can actually buy dividend-focused index funds and exchange-traded funds that own hundreds or even thousands of dividend-paying companies all at once. Think of it like buying a slice of every pizza in the restaurant instead of gambling on whether the pepperoni or the supreme is going to taste better. These funds collect all the dividends from all the companies they own, bundle them up, and send you your proportional share based on how much of the fund you own. It's diversification and dividend income wrapped up in one neat package. Some of these funds focus specifically on companies that have been increasing their dividends every year for decades. We're talking about companies so reliable with their dividend payments that they make Swiss watches look inconsistent. There are companies out there that have increased their dividend payments every single year for more than 50 years straight. Through recessions, market crashes, wars, pandemics, and whatever other chaos the world has thrown at them, these companies just keep sending bigger checks to their shareholders year after year. Now, before you start thinking this sounds too good to be true, let me share something that might surprise you about how dividend payments actually affect stock prices. When a company announces they're paying a dividend, something interesting happens in the days leading up to the payment. The stock price often goes up because investors pile in hoping to collect that dividend payment. It's like when a store announces a sale and suddenly everyone shows up trying to grab the good deals. But then on the day the dividend gets paid, something equally predictable happens. The stock price usually drops by roughly the amount of the dividend payment. This isn't some conspiracy or market manipulation. It's just basic math. If a company is worth a certain amount and they just handed out part of their cash to shareholders, the company is now worth that much less. Here's the thing that confuses a lot of new investors, though. They see their stock price drop right after receiving a dividend payment and think something went wrong. They'll panic and sell, not realizing that they literally just received cash equal to the price drop. It's like complaining that your wallet is lighter after you took money out of it to pay for lunch. This is why successful dividend investors focus on the total return, not just the stock price. They understand that a $2 dividend payment and a $2 drop in stock price isn't a loss. It's just money moving from one pocket to another. The key is owning companies whose stock price recovers and grows over time while continuing to pay those regular dividends. But here's something that might make you reconsider everything you thought you knew about dividend investing. Some of the highest dividend yields you'll see advertised are actually red flags, not opportunities. When you see a company offering a dividend yield of 8, 10, or 12%, your first instinct might be to think you found some hidden gem that everyone else missed. More often than not, what you've actually found is a company in serious financial trouble. That high yield isn't because they're being generous with their profits. It's because their stock price has crashed so hard that even their normal dividend payment now represents a huge percentage of the stock price. It's like when a restaurant starts offering massive discounts on their food. Sure, it looks like a great deal, but you have to ask yourself why they're so desperate to get people in the door. The companies that make the best long-term dividend investments usually offer yields somewhere between 2 and 5%. That might not sound as exciting as those double-digit yields, but remember, we're building wealth here, not gambling. The tortoise wins the race, not because he's the fastest, but because he doesn't get distracted by every shiny object along the way. And speaking of building wealth, here's something that might change how you think about your entire investment strategy. Dividend-paying stocks have historically been some of the best performers during market downturns. When everything else is falling apart and investors are panicking, people tend to flock to companies that are still sending them regular cash payments. It's like having a friend who still shows up with pizza when everyone else has disappeared. This doesn't mean dividend stocks are immune to market crashes. They'll still go down when the market goes down, but they tend to be more resilient and they recover faster because investors know they're still getting paid while they wait for the stock price to bounce back. Here's where dividend investing becomes truly powerful, and this is something most people never consider. You can actually build a portfolio that pays you enough in dividends to cover your basic living expenses. Imagine never having to worry about making rent or buying groceries because your investments are sending you enough cash every quarter to handle those bills automatically. This isn't some fantasy reserved for millionaires. With enough time and consistent investing, regular people can build dividend portfolios that generate substantial monthly income. The key is understanding that this is a long-term game that rewards patience and consistency over flashy moves and market timing. The math behind building a dividend income stream that could actually replace your job isn't as complicated as Wall Street wants you to think. Let's say you need $4,000 per month to cover your basic expenses. That's $48,000 per year. If you can build a portfolio that yields 4% annually, you'd need $1.2 million invested to generate that income. Now, before you close this video thinking that's impossible, remember what we talked about earlier. You don't need to save $1.2 million out of your own pocket. Compound growth and reinvested dividends do most of the heavy lifting for you over time. But here's where most people get dividend investing completely wrong, and it's costing them serious money. They think higher yields automatically mean better investments. It's like assuming the loudest person at the party is the smartest. Sometimes they are, but more often they're just compensating for something. A company offering a 12% dividend yield might sound incredible until you realize their stock price has dropped 70% in the past year because they're bleeding money and probably can't sustain those payments much longer. Smart dividend investors look for something called dividend sustainability. They want companies that can comfortably afford their dividend payments even during tough times. One way to measure this is through something called the payout ratio. This tells you what percentage of the company's earnings are being paid out as dividends. If a company is paying out 90% of their profits as dividends, what happens when their profits drop by 20% during a recession? You guessed it. Those dividend payments are probably getting cut and your passive income stream just turned into a passive income trickle. The sweet spot for most dividend investors is companies with payout ratios between 30 and 60%. This means they're sharing a reasonable portion of their profits with shareholders while keeping enough cash on hand to weather economic storms and continue growing the business. It's like having a friend who's generous but not stupid with money. They'll pick up the dinner tab sometimes, but they're not going to bankrupt themselves doing it. Now, here's something that separates amateur dividend investors from people who actually build wealth through dividends. The amateurs chase the highest yields they can find, switching from stock to stock like they're channel surfing. The professionals focus on dividend growth, not just dividend size. They'd rather own a company that pays a 3% yield today, but increases that dividend by 8% every year than own a company paying 6% today with no growth prospects. Why does this matter? Because of the magic of compounding over time. That 3% yield growing at 8% annually becomes a much higher yield on your original investment after a decade or two. Meanwhile, that static 6% yield is actually losing purchasing power to inflation every year. It's the difference between planting an oak tree and picking flowers. The flowers look prettier today, but the oak tree will provide shade for generations. This brings us to something called dividend aristocrats. And no, these aren't companies owned by people with fancy accents and monocles. These are companies in the S&P 500 that have increased their dividend payments every single year for at least 25 consecutive years. We're talking about companies so consistent with their dividend increases that they make your most reliable friend look flaky by comparison. Some of these companies have increased their dividends for more than 50 years straight. Think about that for a second. These companies have been sending bigger checks to their shareholders every year since before the internet existed, through multiple recessions, oil crises, market crashes, and global pandemics. That's the kind of reliability that builds generational wealth. But here's what's really interesting about dividend aristocrats. They don't just pay reliable dividends, they actually tend to outperform the broader stock market over long periods. It makes sense when you think about it. Companies that can afford to increase their dividends every year for decades are probably doing something right with their business model. They're not just surviving, they're thriving consistently enough to share more profits with shareholders each year. Now, let's talk about something that might make your head spin if you've never considered it before. You can actually use dividends to buy dividends. Here's what I mean. Let's say you own shares in a dividend-focused exchange-traded fund that pays you $600 in dividends every quarter. Instead of spending that money on something that'll be forgotten in 6 months, you can use those dividends to buy more shares of dividend-paying investments. Maybe you reinvest in the same fund, or maybe you use it to diversify into different dividend-paying sectors. This strategy creates what financial nerds call a dividend snowball effect. Your dividends generate more dividends, which generate even more dividends. It's like having a money printer, except it's completely legal, and the government actually encourages it through favorable tax treatment. Over time, this snowball can become an avalanche of passive income that makes your original investment look tiny by comparison. So there you have it. Dividends aren't some mystical financial wizardry reserved for people who wear suits to breakfast. They're simply companies sharing their success with the people who believed in them enough to hand over their hard-earned cash. Whether you're looking to build a retirement income stream or just want your money to send you thank you notes every quarter, understanding dividends gives you another tool in your wealth building arsenal. The key is patience, smart choices, and remembering that the best dividend strategy is the one you can stick with for decades. Now, stop watching videos about money and go make some